Okay, fantastic. Okay, there's a few more people joining, but I think it's 6:05, so we'll make a bit of a start. Hi everyone, great to see you again. Thanks for turning out for the first talk last week with Tony, and hopefully lots of you enjoyed the social on Gather afterwards and got to experience the chaos that it is and the fun that it is. This week, just before we sort of start the talk and I give an introduction to Nicola, I thought I'd just do a bit of housekeeping. You should have all received an email today about the advisory groups and your advisors. So hopefully those will be up and running. Your advisors sort of have some information on how to lead those sessions, and there will just be one a week for the next 3 weeks, essentially. And these are just sort of a personal guidance and setting goals. But yeah, there should be, you should have some information on that in the emails we send out. So this evening, we're really happy to welcome Nicola from Taylor Vinters. So Nicola is, of course, a corporate lawyer, and she has a specialization in IP-centered companies, which is fantastic since obviously all of you, or most of you at least, coming from the bio background, you'll remember from Tony's talk last week how crucial IP is to these sorts of companies. Nicola also has a lot of experience with dealing with the universities that most of you come from, so that's fantastic as well. Nicola's going to be giving a talk, as you can see there, called Structuring for Success. And this talk is really crucial because what it will do is it will move a lot of things from unknown unknowns to known unknowns, or at least sort of known knowns, hopefully. But it's all these actual sort of parts of getting a company set up, which you might not have any idea about now. And Nicola hopefully will give a fantastic introduction to this, and we're really lucky to have her. So Nicola, please take it away when you feel ready.
Thank you. So good evening, everyone. I still haven't quite got used to this whole sort of online presenting thing, so sort of fingers crossed it goes okay. So I'm a partner at a firm called Taylor Vinters, and Taylor Vinters as a firm is entirely focused on innovation and entrepreneurship. We have a really large life sciences team, by way of example, with many scientists who have decided to become lawyers. And to give some context, last year we closed 170 funding rounds, which was near enough one every other day. And we worked with over 700 investors in doing those rounds. And we also did a sort of a sale or an acquisition of a company every 8 days. So we were pretty busy, but every single one of those companies was, I can guarantee, was an IP-centric company. And a large number of them would have started off life as sort of spin-outs from universities. And, you know, sort of we work really frequently with spin-outs from Oxford, Cambridge, Imperial, UCL, KCL, LSE, Warwick, Bristol, and kind of everywhere else really. So that's a little bit about sort of Taylor Vinters and me. But what I thought I would do is we run courses, or I run a course particularly with Oxford University Innovation around structuring and the sorts of things that founders need to think about. What I've actually tried to do is condense 2 talks into one. So we'll see how this goes. And also our BD team got hold of my slides and have put pictures in I don't even recognise, like the one on the front. So we'll also see how that goes as well. So bear with me whilst I sort of feign surprise at what our BD team think I mean by various phrases that I put in here, and we'll see how it goes. So I think what I really want to convey this evening is the importance of good foundations. So if a company doesn't have the right foundations in place, and we'll talk about what those are, it can be very difficult or indeed impossible, and certainly expensive, to try and sort those things out at a later date. And so if, for example, you set up your company and actually you want it to be compliant in order to be able to offer investors a beneficial tax relief. So there are tax reliefs called EIS tax reliefs, which are incentives basically for the likes of business angels and funds to invest into early stage companies. If you make a mistake at this stage, you can't retrofit it later. So I think the thing to sort of take away, the one thing that I would sort of take away is that from this is that putting in place sort of good foundations is critical for a company. Much as I love my litigation colleagues, they're very expensive, and I'd rather that you didn't, you know, sort of have to interact with them at any stage. And so Hence why it's really important to think about what the company needs from the outset. So what do I mean by good foundations? So if you look at successful companies, I would categorize the sort of main legal and commercial foundations to be around ownership of assets. So particularly with IP companies, some founders might have actually been working on developing IP, by way of example, before the company was even formed. And yet you go and raise investment off the back of this intellectual property. So what you need to make sure is that the company actually owns and has a right, for example, to the IP that is at the heart of the company. That might be a license from a university or from a research institution. It could be founders themselves transferring IP into the company because they've worked on something theoretically in their garden shed. But it's making sure that the company owns what everybody thinks it should own in order to sort of continue and commercialize on its successful journey. Protection of assets, we'll talk about all of these things during the sort of during the course of the evening, but protection of assets doesn't just go to intellectual property, it also goes, for example, to employees, and other things. We'll talk about it in more detail. Good governance, so sort of good operational structure for the company, a good set of documents that ensure that all stakeholders in the company know where they stand, and that the practices that the company adopts stand up to scrutiny. And so that might be from an accounting and financial perspective, it might be from a legal perspective, it might be from a regulatory or a compliance perspective. But it's really, again, those are the sorts of things that it's really difficult to sort of retrofit if you don't start off on the right foot. An efficient decision-making process, and again we'll sort of talk about this later, but again, what you don't necessarily want is for your you want to be able to and need to be able to make decisions efficiently. So you need to understand what the decision-making process is, but also in a way that enables you to be nimble as a company. So the last thing you want is to find an absolute ideal recruit for your team and not to be able to do anything about it because you've got to spend 3 weeks going around, getting everybody to sort of consent to things. So an efficient decision-making process that's clear and manageable. And then also sort of your team. But like I say, sort of we'll talk about all of these things in a bit sort of greater detail as we go on. So this is the first slide that my BT team changed. So I had a photo of a couple signing a prenup. Instead, we now have 2 men in suits shaking hands. But what I would describe the sort of governance sort of documentation as being is essentially a prenup for your company. So I used to describe it as a will for your company, which kind of then made it, and then I realized that made it sound like I was expecting your company to die. Instead, what I would describe it now as a prenup, where you might fall out later on. You may or you may not, but if you set out now, whilst you're all friends and whilst you all have a common belief and a common goal, how you want that company to be owned and operated, then that's the best thing to do. It also, this governance documentation, if you have the right properly drafted documentation, actually sets a really good example to investors when you go and sort of try to raise funding. The fact that you've even recognised that you need these documents and the concepts which they introduce can certainly put you in sort of good stead. So what are these documents? So there are two main documents that I would put into sort of this sort of governance box, and that's your shareholders agreement and your articles of association. So again, just these are this is a topic which, again, I can spend 45 minutes to an hour just talking about these two documents. So I'm going to try and do it really quickly. However, what I would say is I will be around at the end if you've got any questions. And also, I will share my contact details. And if any of you want to drop me a line, we're always happy to have coffee, quite frankly, and chat to people about what their plans are. So a shareholders agreement. So a shareholders agreement is a private document, doesn't get filed anywhere usually. And what it does is it governs who owns the company, who are the stakeholders in the company, what do they own and why do they own it. So it might be, for example, that you are founders and therefore you own shares because you are founders. Universities and spin-out companies quite often own equity because they're the holder of their IP. It might be that you have an investor, and in which case, you know, they are a party because they are an investor. So, and what is it that they own? So, you know, sort of, you know, what percentage of your share capital do those people own? Having talked about sort of decision making, what you will see in a shareholders agreement is a process for making decisions. And a company ostensibly can make a decision in two different ways. So it can make a decision and follow a course of action because its board approves that course of action, or it can make a decision and follow a course of action because its shareholders resolve to follow a particular course of action. So one thing to note about the difference between shareholders and directors are that directors have a whole load of duties which they owe the company. Sometimes you might hear people talking about, you know, sort of acting in the best interests of the company, which is an old sort of common law concept, which has now been codified in the Companies Act as being to act to promote the overall success of the company for the benefit of the members of the whole, which is quite wordy. But it is, so as directors, you owe a whole series of statutory and fiduciary duties to the company. Shareholders don't owe any duties at all. They can act entirely in their own self-interest. So that's quite important when you look at what decisions you are going to put and make responsible each camp for making. Now, there are some statutory things which actually just have to be decided by shareholders because that's what the Companies Act says. So if you want to change the name of the company, it's the shareholders who have to pass a resolution to approve the change of the name of the company, by way of example. But there are other things where the Companies Act is silent, where you would expect it to become a board resolution. So that might be sort of opening an overseas subsidiary, or recruiting people, or entering into a lease. You would expect those decisions to be made by a board. What you will find in a sort of shareholders agreement is you can move some of those board decisions up to shareholder decisions. You can't move shareholder decisions downwards, but you can move board decisions upwards. And so what that might mean is, for example, particularly when you've got investors on board, if you are going to spend a lot of money on something, so a big item of capital expenditure, your investor will want to have a say in that. And they will either have the say because they have an investor director on the board, or because they escalate it up to a shareholder decision and they have make that decision as a shareholder. But bearing in mind, when they're in it, if they make the decision as a director, they have duties to the company. If they make the decision as shareholders, they just have a duty to themselves. The other thing that we see with decisions, so you'll have a set of decisions that can be made by a board and a set of decisions that can be made by a given percentage of sort of shareholders. In the same way that you can't move shareholder decisions down to the board, the other thing that you can do with decisions is say, well, okay, under the Companies Act, it requires 50% of our shareholders to agree to change the name of our company. But we really like the name of our company and we don't want it, you know, to be changed, you know, sort of ostensibly, you know, in some situations actually just by one shareholder if they, given the size of their shareholding. So what we're going to do is say, well, we know the Companies Act says that, but between us, we are going to agree in respect of this company that if we want to change the name of the company, the articles of association, if we want to you know, sort of look at that, if we want to reorganize our share capital, we are going to require the consent of a higher percentage of shareholders, and that could be 80% of shareholders, it could be 90% of shareholders, it could be one shareholder from 3 different camps if you've got founders, investors and a university, by way of example. So what you can do is you can increase the percentage required by the Companies Act, but you can't reduce it. So you can't say, well, actually that decision can be made by a 10% shareholder in the case of, for example, change the share capital of the company. The thing to really first of all, you need to be aware of who needs to agree to what in order for you to be able to do things, and you also need to be alive to the process for doing that. So what you need in there is an efficient process that says, if we're going to do these things, we're going to give you X amount of notice, and if we don't hear from you, we're going to assume that you have agreed to it, or something. That tends to go a bit back and forth with investors, but broadly speaking, that's where you want to get to at the end of it. The other thing that a shareholders agreement will contain is information rights. And again, it sort of never fails to surprise people that actually under law, you have very few rights with regards to information about a company, even if you are a shareholder. So what information rights do is, again, elevate the position that is in the Companies Act by actually giving you greater rights to information. So that, for example, might be rights to see board minutes and board packs. It might be rights to see monthly management accounts. It might be a right to know if anybody has approached the company to buy it. And so there's a whole sort of set of rights, usually financial and around the board, that get put into the agreement to say, here is who is entitled to what information about the company. There are also restrictive covenants or covenants and non-compete provisions that we would expect to see in a shareholders agreement that will bite the founders. Investors aren't going to put money into your company if they think that next week you can leave the company and go and set up and do something in competition and come and try and sort of steal the team that you've put together. So non-compete provisions basically prevent you from doing that. You will also have them, or should also have them, in any employment contract that you have. But there is a difference. And the difference is that in an employment contract, those covenants are governed by employment law and would be adjudicated on by, for example, an employment tribunal. And the only party who is able to enforce those covenants is the company, because they are the counterparty to your employment contract. In a shareholders agreement, it's different. So in a shareholders agreement, the covenants aren't governed by employment law, they are governed by commercial contract law, and the covenants can be enforced by the other parties to the shareholders agreement. So for example, it gives an investor a direct right to be able to enforce a restrictive covenant against you. So that's what covenants do, why they're there and why they're important, and why they are different in two different sort of contracts. And then the final thing that you will have in a sort of shareholders agreement is a set of warranties. And the warranties that you give will end up being longer and more complex the more the company grows. But warranties are promises that you are making, for example, to an investor to say, this is the company, you know, sort of, we would like your money. We understand that you're relying on us for sort of certain information and for the fact that we've told you about things. Here is a list of statements which are true. So, for example, the company isn't involved in any litigation. And so it's a whole sort of statement of contractual promises. In the event that that statement isn't true, so let's just say you were involved in litigation, you either amend the statement or you write something that we call a disclosure letter, which is a complete misdescription. The front end is a letter, the middle part is a table, and the third part is a folder of documents or a data room of documents. But what you would do in that instance is say, well, actually, there is some litigation. You know, we've fallen out with our previous employer. You know, these are the circumstances. You know, here's the paperwork that backs it up. And what that means is that an investor then is making an investment in an informed way. So the way that I sort of often talk about this with founders is to say, well, if I go and buy a car, I would like to know that the car has faulty brakes before I get into it, when I've got a chance to fix it, rather than when I'm in it and they fail going down a hill and I go, oh, well, it's okay, I can sue them for compensation. I'd rather that I wasn't in a car with faulty brakes to start off with. So what warranties and disclosure do is it gives you the chance to, you know, sort of get all of your skeletons out of the cupboard. not to be afraid to do that, and to therefore give your investors the assurance that they know what they are investing in. And in the event that those warranties do prove to be untrue because you knew of something and you kind of thought, well, I'm not going to tell them just in case they change their mind about investing, which happens infrequently, I'd like to say. But in the event that that was the case, the investors do have an ability to claim compensation against the company, but also against you as individuals. There are some limits to that and some hurdles they have to meet, both in terms of time frame and the value of the claim. But quite rightly, if you have sort of led them to believe something is true and they invest and then it turns out not to be true, they will seek to sort of bring compensation. People can get quite emotive about warranties because they worry about their sort of personal recourse. Best thing to do is to actually just disclose, and if on the day of completion you can say those statements are absolute, together with the disclosure, are absolutely true, then you've got nothing to worry about. It's a risk that is within your control. So that's your shareholders agreement. And then your sort of second document, and a shareholders agreement is quite operational, it's quite sort of in its format and in its use. Articles of association are much more legal and jargonistic. There's a fair bit of Latin in them. There's lots of statutory references, kind of going back to 19th century, sort of case law and that kind of stuff. However, they are also a contract between shareholders, and it's a contract that gets filed at Companies House. So you can go and look at the articles of association of any company that you can think of. You can go and look at it, for other spin-out companies from your institution. You could go and look at it for John Lewis and Marks and Spencer's if you really felt the need. You can go and find the articles of association of any company incorporated in England, Wales and Scotland. What the articles of association do is they look at the rights attaching to the shares as a unit. So I have this share, I give it to somebody else, that other person picks up the rights attaching to that share. So it will set out ordinarily, who has a right to vote, and it's usually 1 vote per share in early stage companies. Income, so dividends, who has an entitlement to receive dividends, return of capital in the event of liquidation, and then there were also some processes which get set out in the articles of association. So there are processes, for example, for how you hold shareholder meetings and how you hold board meetings, but there are also processes for what happens if the company wants to issue some new shares, or indeed if an existing shareholder wants to transfer shares. And there's usually what I call a right of preemption because I'm a lawyer, but what a lot of people refer to as a right of first refusal. And so there is a statutory right of first refusal in English law. And it basically means that in the event that the company wants to issue new shares, it has to give existing shareholders the right to buy those shares first before they're offered to a third party. And in the event of a transfer of shares, so in the event that somebody wants to sell their shares, they have to offer them to the existing shareholders first before they can sell them to a third party. Very broadly, this is quite a sort of high level view of it, but that is really broadly how it works. You can vary it, but it requires shareholder resolutions and things. Drag and tag are other concepts. So drag and tag are, so a drag along is you're in this situation, somebody comes along, makes an offer for the whole of your company, and all of a sudden you can't get hold of that person that had 0.1% of your company 10 years ago. Or in fact, somebody decides that their signature on a bit of paper is more expensive than everybody else's and holds everybody else to ransom. So what a drag along does is say that when a given percentage of shareholders want to sell their shares, they can force the remaining shareholders to also sell their shares on the same terms and for the same price. What that level of drag along is will depend on your cap table and kind of where the power lies within your cap table. So most investors will want to be able to trigger a drag along by way of example, and what you negotiate is who else needs to participate in that drag along rather than it just being an investor right force. And a tag along is a reverse. So again, what you don't want to do is walk in one day and find out that all of your other shareholders have sold their shares to somebody else and you've been left behind and you're now in business with somebody that you don't know. And so what a tag along does is say, in the event that another shareholder is given the opportunity to exit, or in the event that a certain percentage of shareholders are selling their shares, you can jump on the bandwagon and tag along on that deal and ensure that your shareholding is also acquired on the same terms and on the same price. And then you have leaver provisions. Now, leaver provisions, sometimes called reverse vesting, are also, or can also be, quite emotive in companies. And it's one of these things where there isn't a set, this is what it is in every company by any stretch of the imagination. Normally, when I've sort of sat around a table, I start drawing actual tables to show how leaver provisions work. And I think maybe in the future I'll note to self actually do a slide, because I think it's much easier to see it when it's in a table. But what leaver provisions ostensibly do is say, well, okay, we all thought we were in this together. We all thought we were going to be around for, the early stages of this company, the next, 3-4 years. And actually somebody leaves and, kind of they aren't there in the way that everybody expected. And therefore, what happens to their shares? And there is an argument that somebody who leaves after 6 months should be treated differently to somebody who has put in 3 years of work and then leaves. And there is also an argument that says people leave for different reasons, and that should be taken into account. And so what leaver provisions do is say, in the event that you leave the company, the remaining shareholders in the company have the option to acquire a percentage of the shares of the person leaving. It's an option, not an obligation. So again, you can't go, I'm leaving, brilliant, I'm going to get, somebody's going to write me a check for this amount of money. It isn't an obligation, it's an option for them to acquire a percentage of your shares. The percentage of the shares that they can acquire and the price at which they pay for those shares will depend on when you've left and why you've left. So levers incredibly broadly fit into 2 categories. I would argue they fall into 3, and there is, again, there are some venture capital funds who are quite comfortable with the concept of 3 different categories, and there are some that aren't. But the 2 categories that everybody agrees on is good and bad. So a good leaver is ostensibly somebody who leaves the company through no fault or control of their own. They die, they lose mental capacity. This is regarded as good in a set of articles. Or they are a bad leaver. They commit fraud or gross misconduct, by way of example. They breach the sort of shareholders agreement. And then there is, you can argue for there to be a 3rd category, which is something that sits in between. So sometimes called a neutral leaver, an early leaver, or a grey leaver, which is somebody who leaves but not in circumstances where they are where they've damaged the company. They've just decided to go and do something else, but they might have put in, sort of 2 years of work at that stage, or 18 months worth of work, and they just decide it isn't for them anymore. So they haven't sort of lost mental capacity, been made redundant, they haven't committed gross misconduct or fraud, they're just leaving to go and do something else, non-competitive. And so you have these sort of sliding scales around, okay, why are they leaving? When are they leaving? And as I say, somebody who leaves after 6 months will be treated differently from somebody who puts in 3 years. You then look at the percentage of the shares which which other stakeholders can acquire, and so that might be something like sort of quite high in year 1, so that might be 100% or 80% of your shares if you leave within 1 year. It could drop down to, I don't know, 50%, then 25%, over a course of years. And then the price which is paid for those shares, again, is also sort of dependent on when and why, but by way of example, for a good leaver, it might start off as being 25% of market value, then 50%, then 75%, and thereafter full market value, something along those lines. like I say, it's something that's actually much easier to demonstrate by actually drawing tables. When you actually see them in the documents, they sort of lever provisions cover probably about 5 pages of drafting, because obviously as lawyers we can't just put 2 tables in, because that would be like far too straightforward. But like I say, it is important as a group of founders to recognise that you will be subject to these lever provisions. Every investor will require them, and every round of funding that you do, they will be renegotiated. So those are your sort of key foundation documents from a legal sort of perspective. And then we move
Nicola,
on.
I just wanted to suddenly jump in and say we have a couple of questions in the chat, which I think you might not be able to see.
No, I can't.
So what I was going to do, if it's all right, is I just ask first Zoltan and then Sasha if they want to unmute and ask their questions.
Hi, my name is Zoltan. So my question is that if I'm an employee in a company, can you hear me?
It's quite muffled.
Oh, sorry. So if I'm an employee in a company, and I get shares as an employee, can I see this shareholder agreement, or is it still private too?
It depends how many shares and how you get them, which is a very waffly answer. So if you are a material shareholder and a shareholder agreement is in place, yes, you do. If you are getting shares by reason of, for example, something like an EMI option or an option scheme, then again, the key provisions of the shareholder, you'll be able to see the articles, and the key provisions of the shareholders agreement should be summarised for you. But you don't automatically have a right to see it. It really does depend on, you know, kind of your sort of level of shareholding and whether they are going to expect you to be bound by it.
Okay, thank you very much.
Thank you. Then Sasha, if you want to ask.
Yeah, thanks. So I was wondering, for the warranty table, would an investor come to a founder with a list of warranties they're interested in, or is it a good move from the founder's perspective to provide the warranties before they're being requested, or are the both statements true?
So there will be, this is where you get into sort of negotiation strategy. So I would say you present a list of warranties as part of a subscription agreement. You say, this is what we're prepared to warrant. Most investors, however, and some investors will look at that and go, actually, you know what, that's fine. That's everything that, you know, we would want to you know, sort of cover off. Some investors, however, will just have their own list, and will just have that, you know, it doesn't matter what you present them, they want their list, and they're an investor, and therefore they have, you know, kind of that position to be able to do that. And it's the same, you know, so I think you can certainly say that the sort of warranties form part of the shareholders agreement, or indeed a subscription agreement in later stages. And so, you know, you can certainly suggest warranties, and that enables you to say, well, this is what I'm prepared to do. And for some investors that might actually just be enough, so you kind of control it. But you shouldn't be concerned about, I keep going, you know, you largely shouldn't be concerned about warranties. You should be able to draft the warranties in a way that make you comfortable. The warranties that normally cause most discussion are the ones around business plan, because you can't crystal ball gaze, and you can't be expected to, you know, sort of guarantee what the company is going to do in the future. But again, there are ways and means of sort of negotiating those to an extent that everybody is happy.
Great, thanks.
Okay. So moving on, so this is where I did have a picture of the...
Sorry, I was on mute. Fell victim to the classic thing. We have one more question from Noah, okay. I think, before we move on.
Okay.
Hi, sorry. Thanks, Nicola. I'm just wondering, how much of this would you do with a lawyer? How much could you do without a lawyer? How much would you have to kind of think about before you spoke to, you know, somebody else about it?
It is quite difficult, I would suggest, to do this, if I'm honest, without a lawyer. Particularly some of the legal, sort of making sure that a drag along clause or a tag along clause, by way of example, works. They're actually quite sort of a technical provision. Having said that, it doesn't have to cost the earth, and if you are connected to a university or a technology transfer office, most technology transfer offices will know law firms like us who will do this actually pretty cost effectively. Or indeed, when it comes to spin out companies, we do it entirely at risk. So if you don't receive investment, then we don't charge, largely. And most, again, like the incubators, various sort of incubators that are around and about, again, sort of we have a pack that, for example, we use with Oxford, with the Oxford University incubator, and the incubator actually pays the legal fees of the company to ensure that they have appropriate shareholders agreement articles in place. And if you have a university as a shareholder, this is not something you are going to be able to do between yourselves, because the university will ride roughshod over you, and before you know it, you will have agreed to all sorts of things you shouldn't need to agree to.
Okay, thanks a lot.
But we quite often will have a discussion with a founding group. We will talk them through these concepts, and kind of we'll sort of take a steer. And like I say, there are some relatively plain English, straightforward, but actually what you need documents that can be put in place relatively quickly. It's more when you come to negotiate with investors in the university that it gets more complicated.
So could I just add a follow-up question? Which universities are kind of treat companies better and which treat them worse?
Oh, that's a loaded question. Depends what you mean by treating them, what you mean by treating them.
How trustworthy are they when you're having these kind of negotiations?
So most universities are concerned about their academics still, and don't necessarily want to upset their academics. And so, albeit you will have a fairly robust discussion with the university, university's primary concern is their relationship with their academics who are staying with the university, with their heads of department, etc., that they don't want to leave. And the other thing is university's reputation. That absolutely, if you are dealing with Oxford, Cambridge, etc., Warwick, absolutely key to everything is their reputation. And so the sorts of protections that they put in there is they don't want to be associated with a load of company, or indeed have shareholdings in a load of companies that actually go bust, and then they're left with sort of being seen to be this sort of university that everything becomes illiquid. They don't want to be associated with failure, and so therefore what they will do, certainly in the early stages of the company, will put certain lots of information rights to have director on the board, consent rights, in terms of largely because it's around ensuring the success of the company and limiting any reputational damage to the universities.
Okay, cool, thank you.
That's okay. It does depend on the sophistication of the technology transfer office, is the other thing I would say. So the universities with the big, with the sophisticated technology transfer offices are much better at this than, sort of universities where you might have, where this might land on the, I don't know, one lawyer who also does all of their property work and employment work and everything else, and gets slightly scared by company law. So the other, so again, next slide that was changed by my BD team. So I did have pictures of the men's and English, the men's and women's England rugby teams on here, on the basis that they both won the Grand Slam last year and the Six Nations starts again in 10 days' time. But the reason I had the sports teams up here is because it's a very dangerous thing for an entrepreneur to think that they can do it all. And the most successful entrepreneurs that I know, the serial entrepreneurs, are the ones who have built a good team around them, who recognise that they have limitations, who know how to fill in a skill set, who know when to take advice. I had we act for lots of incredibly successful entrepreneurs, and you know, this I always give the example. There's one entrepreneur in particular who, or in fact, it's a pair of brothers, but this particular sort of brother, I think we've exited 5 companies for them so far. But the light bulb moment for him, I think, was when JP Morgan approached him to buy one of his companies. And he is a great ideas man. He can sit there and just come out with idea after idea after idea. Paperwork and detail, not so much of his strong point. So actually what he did was he employed a really good COO. In fact, it was the person who used to be the commercial director for lastminute.com in Asia Pacific. He was brilliant. And actually the entire sales process was done by the COO, me, and his accountant, because it was just detail that he couldn't cope with. But he recognized that and therefore brought in a team that he trusted. And again, you know, I don't know, she says rather shamefully, I wouldn't have a clue how to change a tire on my car. I could probably sit and watch YouTube for a good number of hours to try and work out how to do it, or I could call the AA. And so again, it's kind of, I could probably sit and work out how to use an accounts, you know, sort of package if I really tried. But again, or I could just go to an accountant. And people often get, when I talk about professional services, people get concerned about cost. Oh, you know, lawyers, they're really expensive. Oh, accountants, they're really expensive. No, go and find yourself the right lawyer and the right accountant who are used to dealing with early stage tech companies. And I think you will find that they're nowhere near as horrendously as expensive as perhaps you might have might think. The other thing to do as well is to make sure that you get the right skill set. So somebody who has worked in a FTSE 100 is not necessarily the person that you want in your early stage startup company, because they will be used to having, a finance director will be used to having a team of 30 people working for him, where he can just delegate everything, throw him into, kind of a startup, and it's, rabbit in headlights time. So actually what you're better off doing is going and finding somebody who has experience of growing companies from this stage to Series B, Series C, something like that, who's done all of this before, who understands grants and grant applications, who understands what an Innovate audit is, by way of example. And so again, it's about building that, don't think you can do it all on your own, and about building that team around you. So the rugby thing was all about the fact that they've got, umpteen different coaches and physios and nutritionists, etc., that enable them to be the best that they can be. I can't emphasize strongly enough how important that team is. So protecting assets. This is going to be the last slide before I tell you to all go and have a break for a bit with homework. But so protecting assets, I talked about protecting assets right at the beginning. And so again, what does that mean from a company's perspective? So IP, if you've got intellectual property, does it need to be registered? Should it be registered? If it's unregistered, still, how do you protect it? Is it something that can be protected by design right or by copyright? Do you have an appropriate process for recording discoveries and disclosures? So intellectual property, and also make sure that you own what you think you own, i.e. get appropriate licenses if you need them from your universities, and ensure that those licenses, that's the other thing, ensure that the licenses enable you to do what you want to do and understand the parameters of them and the limitations on them as well. Which is I've got a whole other team at work that just do IP licenses with universities. Contracts, please don't get a contract off Google. Please don't get a contract off your mate in the law department, or I don't know, somebody's godfather who happens to be a shipping lawyer. They are not going to be able to write you an appropriate data policy. They aren't going to be able to write a contract for you to provide services or products. The way to look at contracts is, again, it's de-risking the business and it's de-risking yourself. So, you want to ensure that everybody is clear about what they're doing. Everybody knows timescales, everybody knows any payments that need to be exchanged under the contract and when they're going to be paid, and everybody knows who owns any IP that's developed underneath the contract. and what's going to happen to it. So contracts of any sort, whether, you know, anything from an NDA through to NDAs, I don't worry about you Googling so much, but we'll just give you an NDA for free. But it's more around if you're going to sell products and services, and if you're doing anything with data in particular, you really need to be, you know, sort of protecting the company, and contracts are the way in which you do that. Employees. If you've put all that effort into recruiting that really good team that we mentioned, you're going to want to retain them and protect them. So you can do that. One, you need employment contracts with them. That also then protects your IP, because it means anything they develop in their employment belongs to the company. So every employee should have a contract. It will need to require to comply with statutory minimum. But the other thing you can do with employees is look at how you incentivize them, and how you make their life better. And as a startup, you're not going to be cash rich, so you're not going to be able to, you know, sort of bung out, you know, sort of really nice, not that we can particularly do it at the moment, but, you know, really nice, you know, all expensive trips to A, B and C, or, you know, big parties, or, you know, big bonuses. However, there may well be other ways in which you can incentivize employees. And one of the most common ways to do this, particularly with early stage tech companies, is to use something called an EMI scheme, which is a tax approved option scheme, where you instead of giving people cash, you give them options to buy shares in the future at a massive discount with lots of tax reliefs around it. So that's what I would say with employees. And also, in terms of protecting everything, make sure that any employment contract has appropriate non-compete and restrictive covenants in. So they can't go and damage your business by setting up with someone else. And then your shareholder agreement and articles, which we've already, you know, talked about in terms of ensuring appropriate processes, and indeed when it comes to sort of people leaving, appropriate leaver provisions. So after that massive canter through stuff, what I'm going to ask you to do, what I'm going to talk about after the break, is actually sort of cap tables, and actually understanding a cap table. So what I'd quite like you to be able to do in the break is actually go away and have a think about what you think the important percentages in a company, share percentages are in a company. And then we'll talk about it when we come back.
Thanks, everyone. So yeah, we're just going to go into breakout rooms for about 5-10 minutes, so you can hopefully meet some people you haven't met yet on the program, and have a chat about cap tables, and we'll bring you back soon after that. Thanks. Hopefully they've all been assigned. Okay, I think everyone's been kicked out of their rooms and back into the main session. I hope you all enjoyed that and got a chance to meet everyone. Well, everyone in your group. And also got to have a bit of a discussion about cap tables. I know to maybe some of you, the idea of a cap table is probably quite a new idea. So Nicola, if you can reshare your screen, I hope you still have the ability, then you can probably demystify this for all of us. And you might be on mute because it auto mutes everyone when they come back in.
Okay, right, we're on. So, like I say, this is part of another talk that I do, but I'm going to try and do this incredibly quickly, particularly in comparison to the earlier one. So, however, it is fundamentally important to understand a cap table. And there are lots of red herrings that people cotton onto that actually turn out not to be that important. And there are also some elephants in the room which actually are important and people don't necessarily realise or don't want to talk about. Why won't it let me? Oh, there we go. So again, this was a slide that had one single red herring. We now have a shoal, and I think the red herring is like, I don't know, on the left hand side, second one up, thanks to my marketing team. So there are red herrings when we're talking about percentages that people think are important, which is hence why I asked the question in the breakout room. And so if you look at what those red herrings are, when you ask people what are the important percentages in a company, a number of people will talk about, oh, well, it's really important to have more than 50%, or it's really important to have more than 75%. And that's because they see that as control, or they see it as that's what you need in order to sort of pass resolutions. However, that is a red herring. So you should think about the situation when somebody has more than 75% in your company, or indeed more than 50% in your company, but not necessarily for the reasons that you think. And so if somebody owns more than 75, if actually the 50% is more important, but if somebody owns sort of 75% of the company, then yes, in theory, they can pass a special resolution of the shareholders, unless your shareholders agreement says otherwise. 50%, however, is actually really important, and it's not necessarily important because it's sort of economic control. It's important because actually if somebody owns more than 50% of the company, there are a whole load of things that company then cannot do. So I talked earlier about the tax reliefs that are really important for a whole load of business angels and a whole load of investment funds like Parkbrook, who operate across a number of universities. Those are EIS funds, and if somebody owns more than 50% of the company, that company cannot qualify and cannot offer investors the benefit of EIS or SEIS tax reliefs. So that's kind of, you cut out, you know, almost half of the UK investment population if somebody owns more than 50% of your company. The other thing is we talked about incentives and incentivizing your teams, and the fact that actually with EMI scheme, you know, and about using EMI schemes. And again, if somebody owns more than an institution owns more than 50% of your cap table, you cannot offer an EMI scheme to your employees. If you are in receipt of Innovate grants, or indeed if you want to apply for Innovate grants, and somebody owns more than 50% of your cap table, it can make it impossible for you to be eligible for those grants. So non-dilutive funding. We can also have an impact on the eligibility of the company to be able to offer immigration visas. So yes, 75% and in particular, you know, sort of 50% are really important, but they're actually really important for reasons that people don't necessarily realise or think about. However, there is another percentage which is actually really, really important, and that's the elephant in the room. The slide that my BD team didn't change. And so the elephant in the room goes back to your shareholders agreement. And in your shareholders agreement, there will be provisions that say, whilst people own a given percentage in the company, they have to consent to the company carrying out particular actions or conducting particular matters. And therefore, actually, the key percentage in the company is the one that changes with every shareholders agreement that we write, because it is the percentage that a shareholder needs to own in order to have a consent right or a veto right. By way of example, in Oxford companies, that's either 5% or 10%, depending on what sort of spin out you are. It can vary over time. Sometimes it can be 25%, sometimes it can be a combination. So it might be actually you need one founder, one investor, and I don't know, one other to vote in favour of something. But it is those consent rights that are actually the really important percentage, because they're the ones that can actually stop a company from being able to follow a particular course of action. And at that point in time, it doesn't matter what the Companies Act says, 75% and 50% goes out the window. What's really important is the operational decisions, and whether a company can or cannot do something will be determined largely by the percentages that are set out in your shareholders agreement. So that's the elephant in the room. The thing that people don't talk about, or they don't recognise or realise, is actually a really important and key percentage. So what I'm going to do now...
Nicola, I think we have a question as well. Sorry to interject.
Okay,
Kyriakos, do you want to unmute and ask?
Hello, can you hear me?
Yes, I can.
I was just curious if like a startup begins through a university project, does that give the right to the university to own shares of the company?
Usually, yes. So most universities will own shares in its spin out. The level of shares that they own will depend on the university and the policy that the university has with regards to spinning out companies.
Okay, thank you.
And we have one more from Marston, if you want to unmute.
Hi, yes, so as you're sort of talking about these various percentages that are needed, I'm wondering, can you then construct new shareholders agreements whenever a critical amount of shares are sold, such that consent and veto rights can change? That way you ensure that, somebody sold a ton of shares, and now what we originally had in place in terms of who might have power, we really need to reconstruct that.
No, absolutely. Yeah, okay. No, definitely. And what you'll find is, as the company grows and as you bring on board more money by way of it, so in the beginning, founders will have quite a lot of influence, as will the universities, around sort of the ability of the company to be able to do something. As the company gets more sophisticated and more investors come on board, what you see is that moving away from shareholder consent essentially to investor majority consent, and things go into the hands of the investors. And then you need to look at actually who is compromised in that sort of investor majority group. So absolutely, yes, it is something that will and should get negotiated each time you do a round of fundraising, a significant round of fundraising. So what I thought I would also do is actually just show a couple of examples of, and they are purely fictional shareholder cap tables. They are there to basically illustrate points. So again, normally if we were all in a room, I'd ask, what can you tell me about this cap table? But in the interests of time and practicality, what I will do is, if this cap table was put in front of me, here would be my observations. So my immediate first observation is the fact that you've got an EIS investor sat at 30. So actually, first thing, the most important column in this cap table is not the last one. So everybody goes to fully diluted, the fully diluted column, because they all want to know what they might own in the event that the company was sold. Forget it, it's the future. It is not important at this moment in time. The HMRC will look at the middle column for determining whether somebody owns more than 50% of the company, and therefore whether a company can offer EMI or EIS schemes, by way of example. So your investors will talk to you about fully diluted. You will absolutely concentrate on fully diluted, but actually the most important column is that middle one, the percentage of share capital that is owned by the different constituents at the point of completion. The right hand side is a fiction that, you know, kind of if all these things happen, then this is what this is going to look like. It's crystal ball gazing. The middle column is the one that's really important. So when I look at this, the first thing I see is that you've got an EIS investor sat at 32%. Now, in order for the company to be eligible for EIS, or to be able to offer EIS, which is this really beneficial tax relief, nobody can own more than 50%, but actually no EIS investor can hold more than 30%. So in itself, this EIS investor would not qualify for EIS because they own too big a percentage of the company. And that's basically my main observation on on this slide, is it's the EIS investor that owns too much. And then actually there's another slide that actually is more useful. So you've then got sort of this cap table. Now in this cap table, again, the big flashing light is the fact that you've got an investor sat with 55% of the company. And even though it might be 46% on a fully diluted basis, that is a red herring. Ignore it. It's crystal ball gazing. The thing that is important is the 55% that they own at the point at which all of this closes, the transaction closes. The other thing that you might sort of notice with this perhaps is if you had, so for example, and I'm giving an Oxford example, but Oxford has a stakeholding level. When we were talking about the elephant, what's the level? It's 10%. So anybody who owns 10% has a right to, you know, sort of participate in various decisions. The founders on this cap table have fallen below that 10%. However, they own more than 10% between them. And so again, the way that we would normally draft, you know, sort of founder rights is, well, you know, it's whilst you're an individual, you have this, but actually as a collective, if you still own a given percentage as a collective, then, you know, sort of you have, you know, sort of an entitlement to participate in, you know, sort of veto rights. Having said all of that about this 50%, and absolutely, like I say, ignore that last column, focus on the middle column. And if you haven't got a middle column, create one. It's no good just having a number of shares and a fully diluted. You need that middle step because it's the important one. Having just said everything I have just said about the importance of 50% or 51, it's just over 50%, it could be 50.001. There are ways for investors or for parties to be able to own more than 50% and for the company still to be able to offer the benefit of EMI and EIS, but it's complicated. It is pushing at the edges of interpretation of tax legislation. And albeit they are structures which the revenue have approved, it does rely on a, you know, sort of fairly what would I describe, a fairly inventive reading of sort of the tax legislation, and not all investors are happy with it anyway. And broadly what it does is it's complicated, but it enables the VC or the investors to still have 55% of the economic rights but not the voting rights, so you reduce their voting rights to below 50%, and you do that by, and there's different things that you kind of do in that's definitely where you need to speak to a lawyer and can't do it without. So there are ways to deal with the situation if you have an investor who is even remotely open to that conversation in the first place. And that's all I was going to say, really. So that's me, or was me, pre-lockdown, and that's how to get hold of me. Like I say, sort of I am based in Oxford, but we do also have offices in Cambridge and London, and Singapore and New York, and we're all a relatively friendly bunch. We have got significant experience in dealing with life sciences companies and spin-outs and early stage companies, and near enough at every stage of your journey after that, and we're always happy to have a chat.
Thank you so much. That's absolutely fantastic, and a lot of information in a relatively short time for obviously what you could cover. That's fantastic. And also dealing with the